Welcome to the monthly 3 Edge View from the Edge for January 2025. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Eric Biegeleisen, Director of Investment Research, Deputy Chief Investment Officer here at 3 Edge Asset Management. And today, as we do each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary 3 Edge research model. Before I get started, I just wanted to point out that Eric has just returned from New York, where yesterday he and other members of the 3 Edge team were at the New York Stock Exchange, where they had the opportunity to ring the closing bell on Wall Street to commemorate the recent launch of our 3 Edge family of active ETFs. So Eric, congratulations on that. Unfortunately, I could not be there getting over the flu back here up in Boston, but it was fun to see them all on the podium yesterday. So that was just great, really fun to see. So let's get started. We enter the new year, 2025, and if we look back at 24, it was a year where extremely bullish market sentiment, optimism over American exceptionalism, potential for benefits of artificial intelligence, all caused a handful of mega cap tech stocks to drive the S&P and the NASDAQ higher in what actually turned out to be one of the most narrow rallies in market history. But here we are now in 2025, and the S&P, as you will hear, remains significantly overvalued, and so the question remains, will U.S. equity markets continue higher from here, or are we in store for an overdue U.S. equity market correction? And I think one thing that Eric will get into is one potentially troubling sign, I guess, from the U.S. equity standpoint is the recent rise of longer-dated U.S. Treasury bond yields, and that could probably serve as a headwind for U.S. equities. But let's get to the source. Let me bring Eric here into the conversation and see what the model research is indicating in terms of what might be in store for the markets as we head into 2025. So, Eric, I will turn it over to you and our asset class matrix.
Great. Thanks, Fritz. And yes, we had a great time. You were missed, and we're glad that you're on the mend here.
Thank you.
Okay, so looking at this asset class matrix, you don't see a ton of movement here. Largely, I think the only arrow that you'll notice here is U.S. moving down. Still positive, but just, kind of in between that mixed and positive one spot. But then if you take a grander look here, you really don't see a lot of attractive asset classes overall. Most of the equities are mixed or negative. Rates remain, credit remains somewhat unattractive. Cash is really the most attractive asset class, quite frankly, when viewed across everything. Gold and commodities still marginally positive, much like the U.S., but a lot going on under the hood here. Reasons to be concerned, as the title suggests, caution ahead.
Absolutely. All right, so let's dig into it, and let's look at our outlook for the various asset classes, beginning with equities, and we can start with the U.S. equity market. What are we seeing there in terms of the model research?
Yeah. So the outlook for our model research is definitely less positive than it was even just a month ago. Still positive as it showed up, as you saw in the asset class matrix, though. So U.S. equities, as measured by the S&P 500, finished the year up 25% even on a total return basis. It did this with its largest intra-year drawdown of only 8.5% peak to trough. And if you look just on a month-end basis, the largest drawdown was just over 4%, right? So not a lot of volatility here. Low volatility year for the market, driven by gains in the so-called Mag 7 tech stocks everybody's aware of. The U.S. equity market did start the year, as the way we measure it, in overvalued territory, as you alluded to, Fritz, and ended the year even more overvalued. So it's on par with levels reached just before the tech stock bubble burst in 2000 and just before the onset of the Great Depression in 1929. Now, that said, valuation, as we know, is not a great tactical timing instrument, but nonetheless, we should all be cautious in the weeks and months ahead, at the very least for a correction, if not a larger valuation reset at some point. The benefits from interest rate reductions by the Federal Reserve have largely been offset by the increases we've seen in long-term bond yields that you mentioned. And in addition, we've seen this investor psychology measure that we calculate, that's losing some steam as well, presumably with this uncertainty surrounding the potential moves by the incoming administration with regard to tax policy, tariffs, among other items on their agenda. So the overall reduction in the outlook is near term, and we'll see how things unfold as the data comes in the weeks and months ahead.
All right, so if we shift our attention outside the U.S. to the ex-U.S. equity markets, I mean, clearly last year, U.S. equities were the place to be, but let's go through now the outlook for 2025 in the ex-U.S. equity markets, and why don't we begin with Europe?
Yeah, European equities, as measured by Germany, returned nearly 10% in U.S. dollar terms, which actually seems fairly respectable considering nearly all the economic news out of Europe, and Germany specifically has been fairly concerning regarding the prospects for any growth at all. While we are seeing an unrelenting push by investors to keep this momentum alive, the inverted yield curve that we measure indicates the potential for just continued economic weakness in the months ahead. So here again, caution is warranted for European equities. Now that said, there is market expectation that the European Central Bank, or the ECB, will need to continue reducing short-term rates in 2025. So with a lag, this could make European equities perhaps more attractive at some point later in the year. But for now, we maintain that mixed outlook.
All right, excellent. So let's move over to Asia and look at the Japanese equity market. What are we seeing there currently?
Yeah, like European equities, Japanese stocks pulled off a 7% return for the year, which again seems somewhat reasonable considering the Bank of Japan, the Japanese central bank, tightening interest rate policy last year, being the last major central bank to bring interest rates positive. The potential issue here with far-reaching impacts across the globe is the Japanese yen, their currency, which weakened considerably last year. If you evaluate that Japanese equity market investment on a currency hedge basis last year, that market was up 26%, actually a bit more than the S&P 500, if you can believe it. So, continued weakness in the yen may help exporters there in Japan, but eventually will cripple that domestic demand for imported goods as they become far too expensive. So we'll need to see a clear direction on currency interventions and interest rate policy from authorities before the model can get particularly excited about Japanese equities.
Yeah, the Japanese equity market, that yen is such a wild card, it really has a big impact. So it's interesting. All right, let's shift to emerging markets. That would include China. What's our outlook there in terms of the emerging markets and the Chinese equity market in particular?
Yeah, well, Chinese equities, unlike U.S. equities, had a roller coaster year, being down over 10% early in Q1, only to be up nearly 50% on the year in Q4. So a bit of a wild ride. It finished up nearly 18%. With broader emerging market equities finishing up about 7% on the year. So still decent numbers if you could stomach the volatility. In general, continuation of interest rate cuts by the Fed here in the U.S. this year could be a positive for China and other emerging market countries. But the positive factor of lower short-term interest rates in the U.S. has been offset by the strengthening of the U.S. dollar, which we've seen. And that's going to serve as a big headwind for EM governments and corporations who borrow in U.S. dollar terms and therefore must repay these loans in U.S. dollar terms. So for the time being, the outlook remains mixed.
So one more emerging market is India. And so what is the model saying about India at this point?
Yeah, India had been a slow and steady gainer throughout the year, a little bit like the U.S., maybe not as aggressive returns, but it peaked at the end of Q3 and has slowly sold off since, finishing up the year about 9% on the year. And while our outlook for India's long-term growth remains positive, the near-term outlook for Indian equities is a bit more mixed. We've seen widening credit spread measures, a slowdown in equity market momentum measures. We've seen an uptick in inflation, and that's combined together to generate some concern in the near term. Again, the direction on interest rate policy from the Reserve Bank of India, India's central bank, would help bring more clarity one way or the other on an India equity investment.
All right, great. So that'll do it for the equity markets. And let's shift our attention now to the bond market and the interest rate environment. And, as I mentioned earlier, we really have seen yields on those longer dated U.S. Treasuries really tick up in the recent past. So what is the model telling us in the overall about the outlook for interest rates?
Yeah. Well, while shorter term U.S. Treasury yields did decline further in December as the Fed reduced those short-term interest rates at their mid-December FOMC meeting, yields on the longer-dated treasuries have begun to move higher, as you discussed, heading more towards that 5% range. And that's negatively impacted the price of longer-dated U.S. Treasury bonds as yields and prices move inversely. An index of 7 to 10-year U.S. Treasury bonds that we often use as a barometer for the space finished the year down 0.6% on a total return basis. That's with all the distributions. So not a great year overall for bonds. The increase in longer-term U.S. Treasury yields has accelerated here now in 2025 and continues to support this notion of concentrating your fixed income investments down at that shorter-term maturity area. Further increases in the yields of the longer-dated Treasuries are going to serve as this headwind for equity market gains and could potentially be that catalyst that leads to a market sell-off at some point. So definitely concerned about that.
Yeah, absolutely. Seeing a lot more in the press now about the potential return of the bond vigilantes. And I have to say that the model has gotten it right to keep us in shorter duration fixed income. So that's been a nice move by the model research there. So let's look at the corporate bond market, where I know you've spoken to the fact that credit spreads have been really historically tight. Are we seeing any change there? What's going on in the credit markets?
Yeah, we maintain that same negative outlook. The spreads are just very tight, and making any additional yield over and above the so-called risk-free U.S. Treasuries is just unappealing. Doesn't seem warranted, worth the risk at this point still.
Yeah, I mean, I would agree. With rates ticking up from here, it's hard to imagine that there not going to be some stress in the corporate debt market on the horizon. So we'll have to keep an eye on that. So let's shift to hard assets or real assets, commodities and gold. And let's begin with gold. What's our outlook now as we turn the calendar into 2025?
Yeah, gold was one of the best performing asset classes in 2024, even outperforming the S&P 500 index last year. It was up almost 27% on the year. The medium to longer term outlook remains positive due to continued geopolitical conflicts on multiple fronts, including the geopolitical uncertainty brought on by that recent fall of the al-Assad regime in Syria, among many other conflicts, right, still raging on globally. In addition, it was recently reported that the Chinese government has again begun adding to their gold holdings. Mm-hmm. So that all said, rising real, that is inflation-adjusted interest rates, and the continued strengthening of the U.S. dollar, we've touched on, that have served as headwinds to continued gains as the price of gold here in the near term. So overall, the outlook remains a bit more mixed nearer term, but longer term, we're still positive and bullish on gold.
Excellent. And then the other piece of the real asset category would be commodities. What are we seeing there?
Yeah, broad-based commodities returned a modest 5% or so gain for the 2024 year. The prospects for a continuation of Fed rate cuts, should they end reducing rates, more than the now 1 to 2 cuts that are expected, in addition to the potential for additional monetary and fiscal stimulus measures out of China, that could also be supportive of higher commodity prices in the months ahead. So we'll just need to see how that unfolds. But like as is the case for gold, the shorter term headwind of that relatively strong U.S. dollar is a near term headwind for commodities broadly.
All right, great. That was an excellent update. Thank you very much for providing us the outlook as we enter into 2025. That will do it for the 3-Edge View from the Edge for this month. Eric and I will be back again in early February with another edition of the View from the Edge. If you'd like a hard copy of our full View from the Edge newsletter for this month, you can always find that on our website, and that's at 3edgeam.com, the number 3 followed by edgeam.com. And all our video content always available on our 3Edge YouTube channel. If you think someone might benefit from them, please feel free to share them. And if you appreciate the weekly videos, also please feel free to subscribe to our 3Edge YouTube channel. We would be most appreciative. So on behalf of Eric and everyone here at 3Edge, thanks for listening.